minutes here. Welcome everyone. Thanks for joining us. Couldn't be a better time, I would think, to do one of these webinars. We'll give it another minute. Compliance has reminded me to put our disclosures up there in nice viewing so everybody has a chance to read them. Standard stuff. Don't act on anything before talking to your professional. Everybody's variables are different. But again, thank you everyone for joining us today. Like I said earlier, I don't know that this could have come at a more opportune time to talk through what we're seeing, what framework we're operating from, and what our proprietary price signals are telling us. I'm Ryan Moomey, the CEO of Sollinda, and with me is Justin Greenhill, my partner in Sollinda, and also our Chief Investment Officer. So getting started, we always start at the big picture, top down. What's going on right now from a top down standpoint? We all know if we're breathing right now, we know there's some issues going on in the international trade front, and there's a lot of confusion of what's the outcome, but also what's the intent. What's the intent of the trade policy? Is it simply to work down our deficit, or is it more targeted to one country like China? And unfortunately, we won't know that until the other side of this. But historically, looking at U.S. tariffs, the proposed moves by the current administration is a pretty large bump in our what has been our tariff policy going back to the mid 60s.
Yeah, again, thank you everybody for joining today. But I think this is by far the most important chart, maybe in the world right now, at least as it pertains to the global economy. And I guess you could say we've got trade barriers at their highest since, depending on how you look at that chart, you could say the 60s or maybe even the 30s. So I think, to your point, Ryan, this is a situation where it's really hard to use recent market action or recent economic action over the past decade or so as a guiding principle. We're in uncharted territory.
Yeah, from a recency standpoint, there's no comparable recently. And looking at the details of the recent tariff rollout, it appears no one can logically determine what the mindset was in determining each country's tariff rate.
Yeah, we're operating under the opinion now that one of the reasons the market has responded so negatively thus far to this whole dynamic with tariffs is to what this graphic illustrates. The market, or thoughtful people would have thought that each particular country would have been addressed individually and would have been looked at specifically, and tariffs would have been applied accordingly. But effectively, what the administration has done is they've taken each country. They've done imports minus exports divided by imports divided by 2. And as you can see in this chart, that is what ultimately creates the starting point for these tariffs, which, one could argue that that is smart or not, but you cannot disagree with the comment that it is very simplistic. And I think a lot of people would push back on this and say that this is not something that should be approached from such a broad brush type methodology.
And that's back to my earlier comment. What's the end game? What's the goal of the administration? I don't know that anyone knows that yet, that it's publicly been determined. But once we know that, we can better predict asset responses to whatever that ultimate agenda is. Moving on to other areas of the global macroeconomic data, inflation still a headwind. It's still higher than the Fed would like, and that can't be argued with by any administrative policies or tariffs. Inflation is what it is right now.
And this is one of the issues that makes the current environment a bit more nuanced than what we've seen over the past 10 years or so, in that, in recent history, once the economy started to soften or the market started to weaken, the expectation could be that the Federal Reserve was going to be quick to cut interest rates and support the economy. But as you can see here, we have an environment where top left on this graphic, inflation adjusted spending across the population is has been weakening notably. Inflation has been going up, and perhaps maybe even more importantly, change in real disposable income transfers, which is the bottom right, has been depreciating noticeably. So we're in a little spot where the economy is weakening from a consumer demand standpoint, just at the time inflation is sticky and could actually go higher based on these tariffs. And we'll get to a bit more on that here as we progress.
Yeah, that's the combo you don't want, where disposable income's going down and inflation's going up. That traditionally doesn't work out well for asset prices. Um, moving on, that was hard data. This is soft data, and soft data has deteriorated rapidly. There's no better way to describe it than that. This is part of the price signals that led to us cutting some risk in December and coming into this year fairly light on equities and our more active strategies. Was just the weight of the evidence was souring. And when there's uncertainty, some of the best things to do is to do nothing and be relatively flat in those types of strategies.
Yep. So, think of soft data as various different measures of people's expectations. And what this chart is basically showing, the University of Michigan has a long and well followed sentiment survey where it basically polls, what is the expectation for the change in unemployment during the next year. And as you can see here, this expectation for rising unemployment has shot up. And this was actually the case, it was already increasing even before the tariff rollout, which has very negatively affected the stock market.
Next slide, looking at unemployment claims versus the unemployment percentage. Again, this would be, one of the next shoes to drop would be companies slowing on their hiring or even cutting back. And as this shows, the data isn't necessarily comforting at this point in the cycle.
To say the least. So, top graphic here is government unemployment, which, as you can see, there's been a sharp spike based on the fact that the federal government is being downsized at present. And then the bottom chart is the United States aggregate unemployment, which, as you can see here, has actually been climbing for over a year now from what was, historically low levels or historically tight levels in the labor market. So the economy has been softening on the margin, even prior to what is now, a pretty big shock in terms of the proposed trade policy.
Yeah, and to Justin's point, we're not so much interested, operator error. We're not so much interested in what's been this rise. We're most interested in where do we go from here, right? If this continues up, I look like John Madden with his illustrator, but if that continues up from here, then okay, we're getting some headwinds to the economy. But if we stabilize here, that could actually, provide some stability in asset markets, and that unemployment is not rolling over. So what's the next catalyst to the downside if, consumers are ultimately have the same amount of spending, which leads us right into the stagflation scenario, where one of the worst scenarios to be in from an asset market standpoint is stagflation. And this kind of shows different scenarios, different equities, how they have performed so far this year.
Yeah, absolutely. We think this is a very telling graphic now with markets moving, 5, 6, 10% per day. This has changed just since we put this on here, but it paints a pretty interesting picture where it basically shows year to date, the S&P 500 has deteriorated while non-US equities have been relatively strong. The S&P 500 is the pink red line, non-US equities is the yellow line. And then the black line is basically companies that do well in so-called stagflation relative to companies that are going to have to adjust down their pricing power or be negatively impacted by a weakening consumer.
And moving on to the consumers or different sociological income levels. This is stock ownership based on income, and it shows this has exploded higher for the top 20% of earners.
Yeah, and you can really see a significant rate of change in this chart from 2010 onward, which obviously, as everyone knows, that was a time when interest rates were put down to zero post the global financial crisis, and equities ended up having a pretty sustained multiple expansion. But what's remarkable about this chart is the top 1% of income households owns over 15% of the stock market versus the next 19% of top economic households owns close to 40%. So you've basically got the top quartile of socioeconomic class owning the vast majority of stocks, which just goes to show that a lot of people will be impacted by the economy, but actually don't care that much about the stock market. And that puts the administration in an interesting dynamic in terms of, do they care about stock market weakness or not?
And this is one of my favorite charts for this, and it's in that, recently the top 10% from an earnings standpoint really haven't been impacted on their spending. But you see that everyone else has been.
Yeah.
And this is mostly driven to the last chart on stock ownership. If people get their statements or are looking and their accounts are going up, they feel pretty good about continuing down their spending path they're on. But if we start to see some rollover in equity markets, traditionally, this top 10% line will go with that, and that last shoe to drop from a spending standpoint will stagnate or come down.
Yeah, I agree. This we say that for several charts, but this might be my favorite as well in the sense that if you look back to the 1990s, the top 10% ultimately contributed roughly the same as the 60 to 90%. Versus in recent years, we've seen the bottom 60% and the 60 to 90% since COVID stimulus wore off. We've seen them deteriorate in terms of their contribution to spending. But as you see, the yellow line, top 10% of households have been really increasing their spending. And we think that's directly tied to what has until recently been a strong stock market.
So let's dig in a little bit. We'll start with U.S. stocks. When we built this, that looks pretty calm. We should have used a different picture because the people on the floor have undoubtedly been a little more chaotic. This chart just simply looks at the first 100 days of an administration, going back to Carter, to Jimmy Carter, and obviously the first 100 days of Trump 2.0 is much different than his first go round or even the average.
Yeah, absolutely. This chart has actually gotten even maybe a little bit worse since we put this out at the end of last week. Depending on when you look at the market, it's moving so fast. But basically, this just shows that not only did the first Trump administration start stronger with stocks, but in fact, most presidential administrations start strong with stocks. And the defined red line there is the current environment, which is I guess you could not deny saying it's a historical anomaly as far as that goes.
And next, even with the drawdown from many historical measures, the stock market, by and large, is not fingertip quotation cheap.
No, if anything, it's the opposite. So as you can see here, we are, slightly below what was very high multiples for a brief period of time during the pandemic. But by and large, there's been a huge period of time over the past multiple decades where the valuation, in this case, price to earnings ratio of the S&P 500 has traded much cheaper than this. So one could accurately say, yes, the stock market has had a rough start to the year and is down a good amount from the highs, but it would not be accurate to say that stocks are yet fundamentally cheap.
Correct, and, we're about halfway through, what will be Justin and I's presentation, so I'm gonna point everyone to the bottom of your Zoom screen. There's a pop-up box with a question mark and Q&A under it. If you have any questions that pop up along the way, fire them into there, and we will, address any questions that pop up at the end. Moving on to non-US stocks, money from outside the U.S. obviously has poured into the U.S. stock market in recent years, and not just stocks. They've poured into U.S. assets, to in some instances just get exposure to our currency.
Yeah, and this graphic represents the rest of the world foreign direct investment in U.S. stocks. And what's just absolutely fascinating about this is if you look at from 2010 onward, the rest of the world has just poured their money into the U.S. stock market. And as such, this has obviously driven stocks higher, it's driven our currency higher, and it has also made our stock market, historically rich on a fundamental valuation basis. So, with growing uncertainty around policy, with issues around trade, we think there is a real possibility over the next few years that a lot of this money that poured into the US that you can see here on this chart could start to reverse and go back home. And that will be both a headwind for the US stock market, but also a headwind for the US dollar.
Which the dollar has rolled over pretty substantially so far this year. Yeah, and we've talked about this quite a bit throughout this year in our various commentaries that non-US equity outperformance has started very strong this year, and historically that usually leads to, when it's this strong, it usually leads to a trend that stays in place for some time. We have to roll with that assumption until proven otherwise.
The bars here, when they're upward bars, as you see the highlighted blue one, that is when the European Union stock index outperforms the United States S&P 500. So as you can see, first quarter of this year was a historic outperformance for Europe. And a lot of that, we believe, has to do with the fact that they're now being forced to do fiscal stimulus in Europe. And whether it be for political reasons or strategic reasons, a lot of big pockets of money outside of the US, in particular Europe, are now looking to sell down US assets and bring that money back home.
Moving on, again, an area of the world that no one really pays attention to, the bond market, when the bond market is substantially larger than the stock market from a volume standpoint and the amount of money that's traded there. So we oftentimes spend a lot of time talking about interest rates because interest rates oftentimes drive what's going on in the equity markets, and we've got villains out there that Justin thought was appropriate to put James Bond in there. So looking back, the 10-year rates are still high relative to the last 20 years. An interesting chart is if you stretch this out to 40 years, it looks vastly different. The bond market has been in a downward trajectory for some time, several decades. And the question is, are we getting back to highs of the last 20 years, or are we in a new regime with higher inflation than has been the case the last 20 plus years, where we should anticipate interest rates, in this instance, the benchmark 10-year treasury, staying higher, staying elevated?
Yeah, we're at a historic crossroads in terms of U.S. interest rates, and to Ryan's point, on a near-term basis, as you see in this chart, rates are high, and one could maybe expect them to go lower. But looking big picture, they are actually much lower than they were some decades ago. And at the same time, we're now back to our prior points. We're seeing a dynamic where a lot of foreign money that would have, recently bought bonds at these levels is now choosing to put their money elsewhere. whether that be in European fixed income, Japanese fixed income, or even looking for various other alternatives. So this is something that we're paying close attention to, this crossroads.
Yeah, and the interesting thing of this last week, is what ultimately drove Trump to get on the lawn yesterday and to kind of pivot a little bit. It was not the stock market. What caused that was the bond market. One of the administration policy points was to bring down long-term yields. That's primarily been driven in by U.S. Treasury Secretary Scott Bessent, but also Trump and various other or people in the administration. They're trying to get long-term interest rates down. And what we saw was some historic runs to begin this year and yields going up, which puts pressure on funding, puts pressure on mortgage rates, puts pressure on everything. And in our analysis, that's what caused the pivot yesterday on the lawn.
Yeah.
And again, yields have started to drop sharply until they didn't, literally in 3 days.
Yeah, as I mentioned earlier, it's very difficult to make a presentation in this type of volatility unless you do it 5 minutes before the
Do
before it's
better,
time to
Justin.
present. But last week it had looked like 10-year U.S. yields and 2-year yields had dropped in response to this dynamic. But flash forward to this week, we've actually seen a historic rise in long duration yields, which, to Ryan's point, this week has seen bond weakness and equity weakness simultaneously, which is a modern, historically rare event. And most importantly, is a dynamic that makes it very difficult for various types of investors to increase risk in their portfolio when they're losing in stocks and bonds simultaneously.
And finally, in fixed income, as we kind of tie everything together, the economic data, equities, and fixed income. The bottom line is U.S. households, by and large, um, looking back 70 years, are historically overweight U.S. equities.
Yep. Top black line there, that is U.S. household equity holdings as a percentage of financial assets. So not only is that at record highs, but referencing our prior slide, that's being held by a historically small percentage of the population. So basically, you've got a small percentage of the population holding more equities than they've ever held, and they're doing it at a time that we would argue is maybe the most uncertain things have been, at least in our lifetimes, if not in maybe a couple generations. So, middle graphic here is cash holdings as a percentage of financial assets. So, people aren't holding a lot of cash. And bottom is bond holding as a percentage of financial assets. And as you can see, people have, in the last 10 years, foregone bonds at the household level to get more stocks.
And this is back to why could this be? Interest rates have been lower, equities have been on a nice run, and people are not rebalancing their portfolios. There's some FOMO there. There's some concentration in the names that comprise the equity markets, at the index level. And these are long-term behavioral patterns. This chart by itself isn't a gotcha where, oh, this is the moment you should do this or you should change strategy. This is something to pay attention to, know where we're at, but it's never going to be an action item or a data point. In hindsight, it will be, but not in real time. It never is. Moving on to commodities, um, oil has taken a nosedive here recently, which is good
Yeah.
for us if you're driving.
This is actually one of the charts that we just had to go in and update, very recently, because this has happened in the last week, where you can see there to the far right, the price of oil has dropped to, over $70 a barrel, down into the low 60s, high 50s. And yes, that is, assuming it stays and the economy doesn't deteriorate, that is positive for many areas of economy, particularly the consumer. But what it really speaks to is that the market is pricing in a significant drop in demand. At the same time, there is an increase in supply. So, we've often talked about commodities in our various different, content pieces and videos, but there were a lot of people over the last few years that were calling for $150 oil. And as you can see here, that was not the case.
And you might say, why is it dropped into the mid 60s? The mid 60s is kind of, that's a point for US producers where we drop much more below that and they start turning wells off because they just don't make money there. But the OPEC regime, I think there's been various measures. It's much lower than this for them to profit off of it. So again, it spills over into other areas of the markets that we're paying attention to. Before I get into some questions, just, bottom line, what do you do in this environment? I've been encouraging our advisor partners to go back to the financial plan, right? The financial planning software that all of our partners, our advisor partners utilize, it runs people's personal variables through 10,000 different scenarios, and it's pricing in some volatility in the equity markets. It's not just pricing in we move gently up from left to right. So what does the financial plan say? Because the shorter term your view, the more uncertain it becomes, and that's whether you're an investor or whether you're investment management like Justin and I, right, leading our investment team. The shorter our time frame, the more uncertain it looks. We have to zoom out and pay attention. And in zooming out, that's our bottom line right here, is taking a step back from this historic volatility and sharp moves in both directions. What is more likely? From this environment, from today, is it more likely that consumer spending will pick up or will slow down? The second is corporate earnings and multiples on their stock share prices. Are multiples more likely to expand or contract from here? And number three is the unemployment, the labor market. Is hiring more likely to pick up or to slow down from here? And that is a starting point for us. Okay, what are our proprietary price signals and all the ratios we look at, all the data points? What is it telling us? And right now, it's telling us to be cautious, as it has been, to not chase, to not fall victim to the mindset of many people that wanted to buy equities yesterday afternoon, right? Had you done that, you eroded capital. So we try to remove as much emotion as possible from the decision-making process. And we encourage our clients, that we serve, to do the same, to take a step back and look at the 10,000 foot picture. And with that, we'll open it for questions. We're running out of time. We've got about 90 seconds if anyone wants to submit any questions. But regardless, I always say this, and I mean it, that it doesn't fall on deaf ears that we get to do this every day. Justin and I are exceptionally lucky, all of us, that we get to do something that we're passionate about and we're interested in, and we get to do it by serving each and every one of our clients. So we are honored, and we assure you we're not asleep at the wheel. We're on top of it. And if you have questions, if you have what I call 2 a.m. moments, where you wake up at 2 a.m. and you're thinking about something relating to your financial journey, I encourage you to reach out to your advisor and talk to them. And we are always available to one-on-one or in a group setting, get together and explain the what, where, when, whys, and hows from our vantage point. What's our data saying? What does our experience say? I've been doing this since the tech bubble, so I have some experience through these types of environments, and I'm not too old and haven't eroded my brain power to forget what it was like. So again, we're here to be a resource for you. This is the time when we need to show up, these types of uncertain environments, and so please take advantage of those. Got a couple questions that came in. Do you think there's an opportunity for the market to rally in the latter half of this year? Absolutely. But there's also an opportunity for us to go lower. Justin and I spent a lot of time yesterday and today looking at different time frames, um, overlaying it with today, and thinking to what was the economic backdrop, what was going on. So right now, we could absolutely paint a picture that if the administration's trade policies work and we reshuffle the deck, 70 years worth of global trading, um, of global trade policy. If we do that, there could be we could be in an unbelievable position, especially domestically, for equity market outperformance. But there's also some scenarios where this turns into from a V-shaped recovery, similar to what we saw in COVID in past timeframes. This is more of a long, drawn out bottoming process for our economy, right? So that's a great question. Um, Another question, the administration basically admitted publicly that the bond market stress caused them to pause. What do you think the future ramifications can be by admitting this fact? Justin, we were just talking about this. I'll let you answer that.
Yeah, that's a great question. To our prior points, I think we would just say that when there's a significant volatility in the bond market and the stock market simultaneously, for us to get a sustained rebound, connecting this to the previous question, we're going to need to see at least one of those, if not both of those, calm down, and probably both. So, to Ryan's point, there's a lot of emotion going on right now in terms of people either being afraid or, quite frankly, a lot of people seemingly being more afraid to miss out. But when the market does well, there are certain characteristics, and Ryan and I have spent a lot of time over the last couple of days, going over what are those characteristics. What does the market do historically when it draws down sharply and then goes into a sustained recovery? And we are at the moment a long way from a data standpoint from thinking that now is that time. So
Yeah, and I'll go back to this chart, right? The Justin's comment that people right now are more likely to fear missing upside than downside. We think it's directly correlated to over the last 20 years, people have been portfolios have become more long equities. It's that recency bias that maybe they forget what drawn out bull market or bear markets look like. So again, we're aware of these things. We're not necessarily acting on them. It's a weight of the evidence. But some really good questions. We're a little bit over. A recording of this will go out in the next day or so. But again, we appreciate the opportunity to serve each of your financial needs. And if you need us, you want to have a long form conversation on any of these topics, reach out to your advisor, and we're happy to hop on a Zoom or a phone call. Hope everybody has a great Thursday and rest of the week. Thank you.
thank you.